Hello, I'm Gravel, the PM at Iron Harbor. Beginning in late May, Chris, Eva, and I began to notice a pickup in a few European data points that we wrote about in early July. At the time, the improvement was limited to PMI, economic sentiment, and other leading indicators, but since then the data rebound has broadened to include hard data like industrial production and retail sales figures. What we're seeing is Europe finally turning the corner, and the economy is in the early stages of what will be a long initial recovery. Long because Europe still faces pretty stiff headwinds like persistent and high unemployment, severely constrained credit availability, and disappointing external demand driven by uneven growth in several emerging economies. Fortunately, even a long initial recovery presents opportunities, and we've made significant changes in our portfolio. But let's start by taking a closer look at the indicators behind our decision. Now, the PMI improvements have been widely discussed over the past month. And the big takeaway here is that France, Spain, and Italy are moving closer to stabilization. So, along with OECD leading indicators, PMI points to further gains in official data like industrial production and GDP. Now, an important component of industrial production is cap goods, and we're closely watching it as a proxy for fixed capital investment. Now, there are four components of GDP. If Europe is going to score 1% growth next year, as the market expects, investment has to play a leading role. Now, as we mentioned earlier, there's also been a notable uptick in economic sentiment, and the surprise here has been the big gains in Spain and Italy over the past 6 months. So with the improvement in PMIs, industrial production, economic sentiment, and retail sales, we're seeing a broader group of data trending higher, indicating the recession is over. Still, the economy faces stiff headwinds. For example, unemployment in France, Italy, and Spain are unlikely to show meaningful improvement for 3 to 5 years. So we expect only incremental gains from private consumption. External demand is beginning to look questionable as well. Several emerging economies are now slowing below potential. India, Brazil, Indonesia, Russia, Mexico. And the risk is that global growth fails to support a meaningful recovery in Eurozone exports. Again, this is why we think capital investment will necessarily play a leading role in GDP growth in the early stages of the recovery. So while we're optimistic that the upturn in activity is in place, the Eurozone faces strong headwinds that will make for a slow recovery. Fortunately, even a slow recovery presents good opportunities, and we've made big changes in our portfolio. In equities, we've tilted our exposure very significantly towards Europe, away from the US, and the decision was driven primarily by valuations. Relative performance of European stocks is at its worst level in 20 years, and forward PE ratios in Europe are 10% lower than those in the US. Finally, and this is the most important, the expected return for equities as an asset class is highest at the beginning of the business cycle due to low inflation, low rates, and the effect of soft labor on corporate margins. So we like a big overweight in European stocks and think the position offers a good margin of safety. There are also good fixed income opportunities in some of the distressed sovereigns, and we specifically like long Italy against French and US sovereign debt. And that's because lower euro breakup risk and better growth should trigger some amount of convergence in sovereign rates. In addition, Italy runs a primary budget surplus, and that's a pretty good argument for the risk premium in Italian debt to be priced lower anyway. Finally, on the currency side, our equity and bond positions are fully hedged, but beyond that, we do have a small short call position on Deck 140 strikes on the basis that a rising euro has disinflationary effects that the ECB wants to contain. So while our base case isn't for a lower euro, we expect any move higher to be limited at 140 over the next 6 months. If you have any questions, please give me or Jackie a call. We'd love to discuss our ideas in further detail.